This is Katie Chambers, back with you on your airwaves with the agenda this Tuesday. And we're mid-conversation, you might say, about how AI is being used within the UAE, financial services model, UAE banks here. We've been talking about, how banks are being guided by the UAE Central Bank on the responsible use of artificial intelligence. But it is raising a bigger question, and one that popped into my head. As AI becomes more deeply embedded in the financial services sector, could it fundamentally change who gets access to money in the first place? Could it prioritise some and not prioritise others? From things like loan approvals, credit scoring, fraud monitoring, risk profiling. Algorithms are increasingly making those decisions that used to sit with humans. At one time in the UK, you'd go and see your bank manager, wouldn't you? You'd go and sit in front of a human, see the whites of their eyes, and, he or she would make a decision on whether they thought you were fit to have a loan, perhaps. Now, supporters say that AI will expand financial inclusion, but then critics are warning that it might reinforce bias or create new forms of digital exclusion. So, I guess it's a big question, isn't it? Is AI democratising finance, or quietly drawing the boundaries on who qualifies? Hopefully, to explain it, it's a big conversation, and one which my next guest said we probably can't fit into 8 minutes, but we're going to try. Is Mark Walker. He is the editor of the Fintech Times, based here in Dubai. Hi, Mark. Thanks so much for coming in.
Thank you very much for having me, as always.
Yes, it's great. And I'm going to ask you the first question from Brandy Scott. She wants to know how AI, figuring out things like your credit score, is any different from the digitisation and algorithms that banks and credit bureaus already use now.
Well, I guess the simple answer is there isn't much difference. I think what people always get confused about when they think about AI is autonomous agents that are doing things all by themselves and have access to lots of different things. Actually, the main difference is the fact that AI unlocks a much larger amount of data. So instead of just using the traditional data that the machine learning tools of old used to use, AI is enabling banks to unlock other areas of data. And what we mean by alternative data are things like, your Netflix subscription, the fact that you're paying a phone bill, the fact that you're paying for Disney Plus. These sort of things have traditionally not been integrated into traditional machine learning algorithms, but they can now because of the AI ability to access large external amounts of data.
So it's almost like a really deep dive into your financial habits. I suppose.
Exactly. That's what it is. And, anyone that's used, all of the LLMs that are on reviews today, the more data you feed it, the more personalised the results come back. And that's exactly what banks are looking to do. They're feeding it a lot more data. They're connecting it to a lot more data sources.
So they'd be looking perhaps at my bank statement, feeding that into their LLMs, the large language models, and then, drawing out conclusions based on what I'm doing, a deeper understanding.
Well, they could. They're not at the moment, I would say. Banks are possibly traditionally not using that at the moment, but they are the sort of areas that could be starting to be used. And that's one of the reasons that the guidance, I think, has now started to be issued, is that banks are looking at these alternative sources of data as a supplement to their traditional scoring techniques.
Yeah, and it's worth pointing out this is guidance, it's not regulation. So it's just, can you please do this and bring this into your framework, I suppose. And the big question here is, does AI sort of make access to finance easier or harder? Does it have the technology to potentially improve financial inclusion, or is there a risk of algorithms creeping in and there being a bias, perhaps in lending situations?
So I think there is positives and negatives on both sides. But I think one of the dangers is that AI is trained on existing data. So therefore, any existing bias which is within that data is going to be amplified. And so if, for example, say there is a particular section of a salary demographic which traditionally weren't awarded loans in the past for particular reasons, that bias will be carried in to the AI. Now, the key with this is really going to be about how banks interpret and train their AI and how they supplement that data to make sure it is more inclusive. So it's kind of a double-edged sword, as it were. And some of this guidance has actually been released by the UAE Central Bank today as actually saying that they must have representative data in their learning models. And that's really the key element to this bit of guidance for that bias and tackling that.
And when you talk about representative data, what specifically is that?
So trying to make sure your data isn't skewed one way or the other. So, men got more loans than women, for example, and making sure that when you train on an equal amount of women and men getting loans to make sure that the AI knows that it's equal.
Okay. And one really interesting thing, our previous guest mentioned, Jamal Saleh, he's Director General of the UAE Banks Federation. He said that, accountability will still be with the humans at the banks. It won't be, with the kind of robots, if you get what I mean. So there's still this sort of human element. Do you think that there is going to be still a human looking at that loan approval as the last port of call? Or really is it that a computer's doing that now?
I mean, there's always been this, from a British point of view, there's always this funny phrase called computer says no, which we had for years and years and years. And we're kind of in that sort of situation, actually, because, and again, the guidance literally mentioned the three versions. You've got human in the loop, human on the loop, and human out of the loop. And so it very much depends on what element the banks decide to adopt. One would imagine that initially they'll very much have a human in the loop. So yes, they would make that ultimate decision. But increasingly, as the AI gets more sophisticated, I would imagine from an operational point of view, they'd want the human to step back a little bit. So they'd be on the loop, so overseeing. So it would only see something if it raised a flag for some reason. The big question is then, when do you go to the third, which is human not in the loop at all? And I think that's the one that people are most nervous about.
Yeah, which I would be, if I'm honest. If you're dealing with money and making money decisions, to not have a brain involved whatsoever, it's slightly disconcerting. Do you think that regulators globally are keeping pace with how quickly AI is evolving in finance?
Not in the slightest, unfortunately. I mean...
That's not very reassuring, Mark.
Unfortunately, I don't think even I'm able to keep up to date what's going on. I had a conversation yesterday. We said, well, we should have this conversation every couple of weeks. And I was like, well, if we're keeping pace on AI, it needs to be every couple of days because things are progressing so fast. But what regulators do have is they still have a very firm view on consumer duty and consumer safety. And that's kind of one of the reasons for the governance that's coming out and the guidance that we're seeing today. So they are still very, very much centred on protecting us. So what that might mean is they may actually stifle the innovation for a while they're getting up to speed. So I don't think it's anything to panic about, but it is something that they themselves are really trying to get to grips with as quickly as possible as well.
Yeah, I was going to say, do you think these regulations could potentially slow innovation, which you've kind of answered, or do you think they could actually help build trust with consumers in AI adoption in banks?
Well, I think it depends on very much who you're looking at when you look at a licensed financial institution. When you look at banks traditionally, you've not been very fast to innovate. So I don't think their pace of innovation is going to change very much. They're still going to be very risk averse. I think the things that are going to be more interesting are going to be in the fintech world, which obviously I would say that.
Yeah, I was going to say, you've got human bias here, Mark. Come on.
I have got a human bias. But this is really, the tech companies are the ones that are going to be pushing the boundaries, are going to be pushing things. And so I think you'll find that a lot of the regulation will be much more focused on those, so we say light financial institutions, the tech players and the fintechs, rather than the traditional banks at this moment in time, because they will be trying to keep that pace of innovation go forwards without suffering anything with their consumer duty.
OK, Mark, always explained very simply and succinctly. Thank you so much for coming in and joining me on The Agenda. That was Mark Walker, editor of the Fintech Times.